So is the credit squeeze starting to ease for European banks? Well, I'm very pleased to say our next guest is Peter Dixon, global equities economist at Commerzbank, and he joins us live now from his offices here in London. Peter, thank you so much for joining us. In terms of this credit squeeze, is it getting easier for banks, or should we be worried as investors?
Well, I think there are indications that the credit squeeze is beginning to ease. Banks themselves clearly trust each other much more to deal with each other, as we've seen by the narrowing of interbank spreads over the course of the last few months. We're also seeing indications that banks are more prepared to lend. It is a very slow process, of course, compared to where we were in 2007. Bank lending activity is much reduced, but at least we do appear to have turned the corner, which is partly, I think, a function of the fact that the economy itself is recovering and banks see better prospects for lending activity.
Peter, how essential and crucial is it that we actually find common ground at the G20 next week, and how likely is it that both the US and the European views can somehow come together?
I don't think we're going to see any concrete agreement on matters like bonuses. There does appear to be a huge gulf between the European position, or the continental European position on the one hand, and say the Anglo-Saxon position, the US and the UK on the other. I think, however, that the finance ministers will probably spend quite a bit of time talking about the things which they can control, which is how to set capital ratios such that banks are much better capitalised in the event we see a repeat of the problems of recent years. But unfortunately, the bonus issue, I think, will continue to be a sticking point.
Now, Peter, you expect the banking debate to really remain at the heart of what we're going to see on the markets for the next 3 to 5 years. How do you see it panning out on that longer term?
Well, I think that to a large degree, the kind of banking sector operations that we have seen over the course of this decade, in which banks acted as a very efficient means of transferring liquidity into the market, that kind of environment is gone. We are operating in a much more capital-constrained world. Banks themselves won't be quite as keen to lend. They certainly won't be as keen to engage in prop activity as they have been. So in terms of what that means for the economy, well, I think it means a slow recovery, nothing particularly startling. It could take 3 to 5 years before growth gets back to trend in many countries. And I think in terms of markets, I think we will probably see a much slower haul with regard to equities, because simply there won't be the finance out there to provide buyers with the opportunities to get into the market quite as easily as they once did.
Now, Peter, you're expecting the recovery to be quite slow in terms of the economic indicators that we should be looking at. A lot of the focus, of course, is on unemployment. What about the housing market here in the UK?
Well, I think the housing market here in the UK, at least, is probably, well, it seems to have reached bottom. It's rebounded. I wouldn't be at all surprised, however, if there's a bit of a double dip in the UK housing market. Primarily, I think, because the market is rebounding on the fact that there's a lack of supply out there. Once supply comes into the market, I think the UK will probably see a further decline in house prices. That's in contrast, of course, to the US, where the market does appear to have bottomed out after 3 years of unbridled contraction.
Peter, thank you so much. Great to speak to you. Have a lovely day.